explain. We now have two segments in our capital markets. One, public markets, mainly exchange-listed equities and treasuries and other classes of debt securities, including municipal bonds. And two, private markets, private equity and venture capital investments, and certain classes of debt securities. 25 years ago, the public markets dominated the private markets in virtually every measure. Today, by many measures, the private markets outpace our public markets, including in aggregate size. Now I'll evoke a common critique of economists. Harry Truman and many others have longed for a one-handed economy. This issue needs multiple hands. I'll attempt to use only two. On the one hand, the breadth, depth, and nimble nature of our modern private capital markets, which is both unrivaled and coveted around the globe, has substantially contributed to the competitiveness of the U.S. firms and the performance of the U.S. economy generally. We should not do anything to impair the effectiveness of our private capital markets. On the other hand, we have roughly half the number of public companies we had 20 years ago. Growing companies are staying private substantially longer, and public equity markets are being used more for liquidity by private equity and venture investors than for accessing new growth capital. The problem is, Main Street investors generally have access to only one hand, our public markets. They have extremely limited, and in many cases costly and otherwise less attractive access to our private markets. This should not surprise any of us. Let's go back to the economists. For a host of reasons, including our approach to regulating participation in these markets, the marginal cost to a company of including an individual investor, other than perhaps friends and family, in a private offering is very high. On the other hand, because individuals generally can commit substantially less capital than professional and institutional investors, the marginal benefit to the company of including such investors is very low. Said another way, willing buyers and willing sellers cannot meet efficiently. This is where I turn to my friend SP and say, George Akerlof, Market for Lemons. I love to cite this work. I do it all the time, probably more than I should. But anyway, for the students in the room, they know it well. Akerlof explained why, for a long time, the used car market included only bad used cars. Why? Why did it include only lemons? Because you could not tell a good used car from a bad used car. Accordingly, buyers assumed all used cars were bad and priced them accordingly. They priced low. In turn, because buyers offered only bad or low pricing, sellers offered only bad used cars. This problem has actually been partially solved by incentive alignment and information temperament techniques, including enforceable used car guarantees, certified pre-owned. I believe this situation, both the public hand and the private hand, should be addressed. We should increase the attractiveness of our public capital markets as places for companies to raise capital, not just find liquidity. And we should increase the type and quality of opportunities for our Main Street investors in our private markets. On the public market hand, our Division of Corporation Finance, led by Bill Hinman, can boast many recent initiatives designed to increase the attractiveness of public markets while maintaining or enhancing our unparalleled commitment to investor protection. I'll rattle off a few. Modernizing financial disclosure rules for business combinations and debt offerings, expanding key Jobs Act initiatives to more public companies, and recognizing that one size does not fit all, permitting scaled disclosure by public companies. Before I turn to our efforts to broaden investor access to our private markets, I want to make another point about our public markets. There's a product that we utilize countless times a day, has almost incalculable social value, dyslexia, and often is overlooked or at least taken for granted. The product is market prices. Prices for stocks and bonds and other assets generated by markets that are transparent, information-rich, and fair are of immense value to our economy. They are, to cite Paul Samuelson, again, public goods. Generally, once prices are published, we we can all use them. Like lighthouses, they are, in economist speak, non-excludable and non-rivalrous. In most cases, I cannot keep you from using price information. And my use of price information does not affect your ability to use that information. There is more. Main Street investors can be confident that public company stock prices reflect the views of professional investors. This is the rare kind of free riding that economists adore, and it underpins Alfield's random walk down Wall Street and the rise of passive investment. On the other hand, from the perspective of firms, managers making long-term decisions, such as whether to invest in human talent, equipment, and research, rely substantially on metrics that are themselves dependent on today's public market-generated pricing information. These include EBITDA multiples and cost of capital estimates that, now get this, somewhat ironically, these public market-generated pricing metrics are essential to the efficient functioning of our private markets. Now, Congress and the SEC have long sought to expand Main Street access to our private capital markets while preserving investor protection. Recent initiatives include regulation crowdfunding, expanding Regulation A, and lifting the ban on general solicitation for rules under Regulation D. These various efforts have had benefits, but they also have added what I would say are new patches to an already patchwork regulatory framework that remains rooted in income and wealth tests for investor access. We're taking a fresh look at this framework with the aim to increase access to our private capital markets for our Main Street investors, including examining whether appropriately structured funds can facilitate Main Street investor access in a manner that ensures incentive alignment with professional investors, just like our public capital markets. Main Street investors and professional investors are in it together. Let's find a way to fund that they're in it together, and otherwise provides appropriate investor protection. Stay tuned.